I'll call the meeting to order at 8:04. Welcome everybody this morning on a snowy, non-snowy morning. It's not forecast, but it's certainly snowing. Are there any adjustments to the agenda? Hearing none, are there any members of the public in the boardroom or online who'd like to speak?
I'm in the boardroom.
And we can move right along to the December minutes. A motion would be in order to accept the minutes as circulated.
So moved.
Thank you, sir. Is there a second, Will?
Yeah, I will second.
Thank you. Any more discussion, corrections? All those in favor, please say aye. Aye. Anybody
Aye.
opposed?
Aye.
Any abstentions? The minutes are approved. All right, move on to finance updates.
Okay, so I don't have a whole lot. We started late, so I'm not gonna take up too much time. And I don't know what Tim has, but you have October and November financials. Just know that the November results, we have the majority of expenses in there, but there might be a couple things missing. The capital section also is not complete, so depreciation isn't included, which is why you will not see a balance sheet this month for you folks. The annual audit is taking a lot longer than we would like. I don't know if there's some new single audit rules. I think the COVID money has complicated things, but historically, we've always brought you the audit in February. We're thinking it might be more like April or May this year, so apologies for that. We're going through the process. We do have a new auditor. This is actually probably something that's very healthy, to be honest with you, to go through this in-depth process, but I've been very impressed with my staff because they have provided a significant amount of material to the auditor. So it's been a lot of work on both sides. We're hoping we'll have the audit for you soon.
Nick, you say we have a new auditor. Is it really just an audit manager? Same audit company.
Yeah, we don't have a new auditor. It's just a new person from the audit firm.
A new manager, yeah.
Yeah, and we've never. She's on the grant side, so we have a regular audit that looks and makes sure we're following, you know, GAAP and GASB and everything, and then we also have another audit on top of that where they actually go through our grant results and make sure that we're following all the rules from the FTA. So it's almost two audits in one. The one that's taking a lot longer is the single audit portion. It just seems like it's a never-ending process at this point, but we're hoping we're towards the end of that. I know especially Tim and some of my staff are hoping as well, but we'll be patient and we're going to go as quickly as possible. Dan, you have a question?
I do. Thanks, Nick. When you say it'll be delivered in April, does that mean the audit won't be completed till April? Your grant has a requirement to have that to us in March.
Yeah, well, we will do the best we can, Dan, to have it to you in March.
Thank you, Nick. I appreciate that. Actually, I was leading down a different path.
Okay.
That maybe because audits are taking longer, the requirement needs to be revised. And so, because you're not the only one that I've heard that their audit's going to be starting late. Or not even starting late, just taking longer than that has happened in the past. And so, yeah, thanks. I'm just gathering information. Appreciate it, Nick.
Yeah, no problem, Dan. I will say I will do what I can to make sure we have it to you in March. We just need to get it back so we can review it. And then it's kind of like, you know, the state grant agreement. It's a little bit of back and forth to, you know, iron some things out. Once we do that, it shouldn't take very long. The next part obviously is getting it in front of the finance committee and the board to get it approved, and sometimes that can take longer. But you know, maybe I don't know if the grant I don't know if we can provide you a draft audit and that can kind of suffice. You know, it won't be board approved, but you know, it'll be in draft form, and maybe that would be enough for you folks.
It has to be filed at the, oh my goodness, is it the federal audit site?
Yeah,
is that
the clearing.
That's correct. Yeah, that's where we go to get our copy. So it has to be that version. So if I don't think that's the one that is draft. So.
Well, I have a long overdue call with my friend Ron at our audit firm, and so I will talk to him and see if we can get things maybe rolling a little bit quicker so we can make that deadline.
And something just for folks to know that's separate but sort of related is that we know that we'll have our FTA triennial review in April and May as well.
Well, yeah, so we are looking forward to that a lot, I can tell you. So we have to provide a lot of data by the end of February. And so we'll be working all hard on that over the next couple of weeks. The only other thing I have is just we got results for the workers' compensation audit. I continue to not do a great job of forecasting the payroll that I think we're going to have when we go through the renewal. So we had about a $55,000 extra premium added on because our payroll ended up being so much higher than what the estimate was. It was in the drivers and the maintenance areas, big surprise, and we came in lower than expected on the admin. So because the drivers and the maintenance have such a much higher risk level, obviously the premium's higher. And so that's really what kind of drives that. But I am going to shoot for the stars next time and not be I need to be less conservative when I'm estimating payroll for that, so there's no big surprises at the end of the year.
Well, Nick, that helped your cash flow.
No, it doesn't. Well, it helps my cash flow at the start, and then I got to pay it later on. So, I guess, yeah, it depends on what the timing is, but clearly, yeah, I think the problem was that was before some compensation changes and some new contracts that went in place, and that really is what drove the variance. So, but still, we'll shoot to do better next time. That's all I have. Tim, do you have anything?
I just wanted to mention that Matt and I just attended the triennial review workshop, which is going to help us as preparing for this review that's coming up. Our materials are due to the reviewing firm by the 28th of next month. But we had some helpful tips that were provided during the workshop on to better prepare ourselves for this review. We've all been through these reviews before. I've been through them at the state level as well as through GMT through the triennial process. That's really all I had, other than just provided some additional information, Dan, to the auditor yesterday. And I did want to thank you and Susan for part of the request that we received from the auditor. They're digging deep this time around, but I think we're very close to the finish line there on the audit materials that we provided.
Okay.
Any questions?
Yeah, I had a question for Nick. Back on the workers' compensation, just for my information, could you talk a little bit about the cycle for that? So you said, we're going to try to do better next time around, but can you walk through the time frame of how you develop that projection?
Yeah, so basically about, I'd say, let's see, what is the timing of that? I think about it October maybe, or August. We go through a annual commercial insurance renewal where we work with our broker and we determine, hey, do we want to put it out to bid for everyone, or do we want to just talk to our current provider and see if they would be willing to give us a good deal and not test the market. So we really rely on the expertise of our insurance broker to make that decision. Once that decision is made, the insurance company, whoever it ends up being, request a significant amount of information from us so that they can price the risk that GMT has based on a workers' compensation and all the other commercial insurance lines, cyber, whatever. And so when it comes to workers' compensation, what they want to know is, number one, what was our experience rating for the last couple of years, which drives some of the pricing of the premium, and then also how many wages you're going to have in each subgroup of employee. And the problem here is the wages were not high enough, as well as some of the groups were a little bit higher in terms of the allocation of the wages. And so What happens is I give them an estimate of what I think the wages are gonna be, they come up with a premium, we pay that premium through the year, and then at the end of the year, there's an audit done, and there's a true up, so either we'll get a debit or a credit on the bill based on how close we were. For the last couple of years, I have not been close enough, and so we've had to pay them additional premium dollars.
Okay, that's really helpful for my understanding. Thank you.
Yeah,
How was
no
your,
problem.
how was your classification, Nick? That come out pretty well?
No, that was the problem. That was more of the problem than the like total wages. The total wages, I think were not as bad. It was just where the wages were. Like it just the allocation was much higher for both the unionized positions, like the drivers and the maintenance, and that's why the premium was so much higher, because the premium's so much higher in those work groups because they're so much more riskier, right? Like someone in maintenance has a much higher chance of getting hurt than like someone like me who's an administrative employee. Half the time, the problem is we argue about what classification someone should be in. Obviously, I'm always arguing that that person should be in the administrative bucket, whereas the auditor, the insurance company is saying, no, they should be, you know, in this bucket. And so we go back and forth, and you might remember last time, that's what happened. And they at first came back with like something like $120,000 additional premium, and we negotiated that down to like 30. Because we finally got them to agree that, you know, these employees should not be charged at these high risk levels. So,
Thanks, Nick.
yeah.
Any other questions? If not, then we move right along to the October financial review.
Okay, so I'm gonna pull up a PowerPoint. Let's see here. Let's share this. Here's the- Use. Oh, there we go. Sorry, the button disappeared for some reason. Share screen. There we go. All right. I'm assuming everyone can see this. So we're going to talk about the first 4 months of the fiscal year. We have complete October results, as you know, because of some of the billing on the rural side, really kind of slows us down in terms of providing current financials. So we're always about 2 months behind, but to help out, we do include you have November expenses as well in your materials that I sent you. So if you want to go an extra month ahead, you can kind of see where we're at on an expense level, but please understand there's no revenues in there, right? So the loss you're seeing on the November results is not accurate. It's just because we haven't done all of our grant billing yet. So this is where we are as a whole as of October. So you can see had about a $9.85 million of total revenues, about 10 million total expenses. For GMT as a whole, we've got about a deficit of $164,000. I'll dig into why we're seeing those deficits in a minute. We can't give you any change in net assets yet. As I mentioned, because of the audit, we haven't closed our capital accounts for the previous fiscal year. So we're not able to calculate depreciation or things like that. And that's why if you look at the October financials, you're not gonna, down in that capital section in the way bottom, you'll see no depreciation or anything like that. So we'll have to wait on net asset calculations for future months. We're hoping we'll be able to bring that to you soon. And then breaking it out between urban and rural, we've got about a $59,000 deficit on the urban side. And again, I'll go into why we're seeing that. It's not technically, it is a deficit, but it's not a deficit that we couldn't get rid of if we really truly wanted to. So I'll go into the intricacies on that in a couple of minutes. And then on the rural side, a little bit higher. We've got about $105,000 loss on the rural side. And again, I'll go into why that is happening as well. Oops. So we'll start at the top. We'll look at the revenues, the budget to actual. A couple of things, and this is really hard to see. I apologize for that. But the main thing I want to point out here is, and if you can see it, which you probably can't, this is all right because we'll dig into this a little bit more as well. Let me see if I can zoom in here. Okay, there we go. Hopefully that's a little bit better. But so the federal urban formula grant, you know, again, that's 5307. That covers a large share of the urban funding. We're at about 33.5% for the year. The benchmark we'd like to see is about 33.3. We'll dig into that a little bit more, but just looking right now, you know, we're kind of right where we'd like to be for that. However, there is one big caveat that we have been using our 5311 flex to 5307 funding for the first 4 months of the year. So that's why we're so far over benchmark in that, and that is under other state grants. So you may remember that VTrans gives us about $355,000 a year that we use. It essentially is 5311 money for their rural service area, but it turns into 5307 when they flex it over to the FTA. That funding we've been told is going to be going away in the future, but we do have some years left of that. And so we're actually using 2 years worth in this fiscal year, which helped out FY25 quite a bit. But that's why we're so over benchmark there, because I told Tim to draw down all those, as many of those funds as he could to use those up. So they got used up quite a lot in the last couple months. Just looking at the rural side, one thing I'll note here, and we'll go into more detail, is just E&D funding. So our O&D program, which is on the rural side, that's a program that provides service to older folks that are over the age of, I think, 65 and or have a disability. It's demand response. It's on the rural side. We are seeing spending for that basically be lower than last year. And I'll talk more about that. That's a lot behind why we're showing that $100,000 loss on the rural side. And there's some intricacies on why that's occurring. So when we get there, I'll walk you through that. But you can see last year at this point, we spent $628,000. We've only spent $620 year to date. I'm telling you, the demand is probably higher or the same as last year, and our transit rate is much, much higher. So there's a reason that those grant funds have not been coming in at the same pace or higher than we'd expect, and that's really what's driving the loss. So, but we'll talk more about that shortly. Down below in the operating revenue section, the main thing I want to point out is we're doing okay, you know, on fare revenue. We've got about, you know, the benchmark's 33. We're at roughly almost 35. That's good to see. We're roughly on paratransit fares where we'd like to be. A lot higher on advertising income. So I'd say, you know, on the urban side, we're doing all right, but well, you know, obviously I'd like to be higher than that 34.6, just to give us some breathing room on the urban side, but you can't have everything you want. And then on the rural side, you know, the big worry here is always Medicaid, and that's that 31.7% figure. So we're a little bit lower than I'd like to see on Medicaid, but that's really driven by the demand. So I think the demand is a little bit lower than we were at this point last year, as well as we had some gains that have been paid back in this fiscal year from last. So they've lowered the revenue they're sending us to pay back some of the gains we had last fiscal year, which is really what's driving it a little bit below benchmark from last. So I'm not, you know, overly concerned, but it's one I always watch very closely because Medicaid is one of those programs that can really drive the bottom line on the rural side. But, you know, in total, what we really want to see is we want to see our federal, state, and local revenues, which are up here. We actually want to see those as far below benchmark as we can get them, because if they're above, it means we're spending more grant balances, you know, than we have budgeted. And so you can see we're below on both urban and rural currently. And then on the operating revenue section, I want to see that as high as possible, as high over benchmark as possible. And so, you know, you can see on the urban side, we're accomplishing that. We're pretty darn close on the rural side, but a little bit below. So, which is primarily driven by Medicaid. So let me zoom out there. And just the breakout of what this looks like as a share. You can see a lot of diversity at GMT and where the money comes from. But you know, the primary buckets are other federal grants and 5307. The other federal grants includes things like CMAQ, which is funding provided by VTrans to fund certain routes that are applicable, as well as, you know, preventative maintenance, which is also funds that are provided by VTrans. Those fall in those other federal grants bucket. And we've seen CMAQ over the years, both, especially on the rural side, become a much greater share of our grant balance. Mostly because it has that attractive 80-20-20 split, meaning the local match is much lower than it typically is if you use a 5311 funding. And then, you know, we've got assessments, obviously Medicaid revenue, operating revenue, and, you know, a number of other funding sources. But, you know, this is why GMT is a fairly complex organization. We have quite a lot of streams of funding that are coming in that need to be tracked and billed and whatnot. So, yeah, it's quite a lot, but we seem to manage it. And just what that looks like compared to last fiscal year. So not a ton of change. You'll notice the biggest change is really a major drop in 5307, right? So, and that's really driven by the operating revenues growing. And that's because we've had fares in place for much longer portion of time, which is helping take some load off of the 5307 funds that we've been drawing down. And then other federal grants is a little bit higher. You know, state operating is a little bit lower because, again, you know, the fares are taking a little bit of the burden off of that funding source. And Medicaid, again, a little bit lower. Like I said, we did have to pay back some gains, so I'm not overly surprised by that. You know, I'd say the biggest change is really the operating revenues and the change in 5307. We'll take a look at, you know, what this looks like both on the urban and the rural side. And, you know, as you'd expect, kind of the same thing, right? You know, a huge change in the 5307 apportionment due to the operating revenues coming back in place. You know, state operating, again, a little bit lower just because, number one, the amount we got was higher last year. We also had some carry forward money from the state that we used last year. So that really drove up the state operating funds amount. And we also just barely started recognizing that extra money that the legislature gave us, that extra $630,000. So that also is driving down the state operating funds. So we expect that number to get up, to grow a little bit more in the coming months as that money starts getting recognized in the revenue. And then the other federal and state grants, again, this is, you know, the usage and budgeting of the JARC funds that I told you about. We're using 2 years in one, as well as just higher PM and CMAQ costs all around. And then looking at I like to show this chart every time just to show you the progress. As you mentioned, a lot of GMT's woes is really just this purple line up here getting higher and higher. You know, this is the federal, state, and local shares. And you can see, you know, the burden on the federal level kept growing and growing. That's kind of why we're in the place we're in today. So I like to, you know, just show you where are we at, you know, year to date for FY25. You can see that we're not heading in the, you know, in the right direction, at least at this point. But, you know, we built our budget with a lot of federal money. And so the hope is that, you know, we'll see that curve bend downward, either from funding coming from other sources in the future or reductions in spending. Just looking at the rural side, and there's a lot more parts on the rural side than there is on the urban, but you can see, you know, again, Medicaid dropping a little bit from the start of last year. Other federal grants is a little bit higher. We've been spending planning money a little bit quicker than we were last year, which is driving that. E&D up a little bit as a share. But not a ton of change. It's not nearly as dramatic as, you know, the urban side because of the restarted fares. And then just, you know, looking at revenue from a budget standpoint, you know, what are we paying attention to? And I kind of already went over this a little bit, but this is just GMT as a whole. So, we've drawn down or taken in recognized $9.8 million of revenue. So that's about 31.5% of our budget. What are the things we're paying attention to? Really, rural advertising revenue, we're likely gonna have to, I think we already took care of that, to be honest with you, in the 26 budget, we dropped it. We just haven't been seeing the revenue come in lately for the rural side. And then Medicaid, again, we're always paying attention to Medicaid, so. Now we're gonna look at costs. We're gonna start with some cost trends. I like to, dig into the transit rates a little bit. I will say on the urban side, we're seeing the benefit of, higher or lower per unit pricing, really that's driven by the amortization of the one-time funds or the one-time spending, things like bonuses that happen in July. But also, our scheduled driver payroll hours on the urban side have actually been going up for the first 4 months of the year. So that's really what's pushing down the transit rate on the urban side. On the rural side, we are having some difficulties. Certainly the costs are up, and I'm going to dig into each one of these a little bit more in a second, but I would have expected this to start going down. It has not. A lot of that is due to lower vehicle hours, higher expenses. We're kind of getting the double whammy on that. We also are thinking there might be some issues in the data that we're getting out of Route Match, because we're seeing a tremendous decline in vehicle hours, especially in van specials, which can be hard to track. And so we're looking at that closely with our consultant, Stephen Falvey. Things are just not exactly making sense to us from what we're seeing in the hours on the rural side. So we're hoping we'll have a resolution to that. We're hoping that this transit rate is actually much lower than is showing right now. So looking at the urban rate and how that changed over last year at this point. So this is the blue line is where, and these are year to date, right? So these are averages at, this point in time. So like, for example, as of October, we were at $127 per scheduled driver payroll hour. That's the average for all the hourly service we've had at this point. And then FY24 was just a little bit lower than that, 124. And just this is helpful down here, just looking at the expenses, so you can see, okay, our expenses are about 8% over where we were at this time last year. But the rate didn't jump up so much because the vehicle hours went up with that, right? So our total, this is not correct. This should be scheduled driver payroll hours. That's what we use on the urban side. So excuse that. But so at this point last year, we had about 40.7 thousand scheduled driver payroll hours. This fiscal year, that's jumped up to almost close to 43,000. So with the denominator growing, close to what the expenses are growing, that helped keep the rate from, exploding upwards. This did not happen on the rural side, and so that's the problem. So on the rural side, our expenses are up 18%. So up close to 300 or close to almost 400,000 or 350 from where we were at this point last year, but our hours have actually gone down by 7%. So you had the double whammy of having higher costs, but actually lower service. And so that's what's not making sense to us at this point right now. And it's primarily all in the van special hours, which is all demand response. So that would include things like our Medicaid van special trips, our O&D van special trips. Something does not seem right there. So we're really gonna dig into that and hopefully have a resolution soon, because it just seems like these higher costs could not have all just been strictly an overhead. It had to be some and more driver hours. So, hey, Chapin,
got a question?
Yeah, Nick, I understand you're worried about the denominator here with how Route Match is reporting, but the numerator on expense is 18% year over year. That's not making sense to me either. Can you talk about that?
Well, we had a new contract, Chapin, that went into effect that gave 7% raises, $3,000 bonuses, there was staff that was hired, and they're starting to fully show in the results, primarily in our broker services operations. We hired, a staff person down at the MTC, a manager there. The health insurance benefit that we used to do a cost share with the rural drivers for healthcare. That went away, so we saw a lot of folks taking higher value plans. So there was a lot of things that went into that. Yeah.
Thanks.
But yeah, no, quite a big increase. I understand the increase more than I do this, and so we'll dig into that, and I'm happy to bring forth like what that 360 was made up of at a future meeting, just to give you an idea of, like, you can see, okay, how this was from, this portion of it was from, say commercial insurance, this portion was from wages, just so you can kind of get a better sense of what that breakout is.
Hey, Nick, does MyRide have any impact on the driver hours?
Yeah, I mean, it's I believe we do have a fixed level of vehicles on the road. So, but yeah, I mean, that service was definitely more expensive than what we had in place up there before. And we're actually looking at some different possibilities for service up there in the near future. I know that Dan is talking to Monica, and we're working with V-Trans, and so I think that service could be changing away from possibly more demand response to more fixed route, but I think that's still kind of to be determined at this point.
And I can add a little bit there. So one of the things that we're looking at is that the current MyRide service area is somewhat duplicative in the sense that it provides service along the city commuter route. We think that this is driving people to MyRide instead of using the fixed route. So we're looking at a smaller service area that will hopefully contain costs and get people back to using the city commuter. There is the potential, though, that we'll be looking at having two routes there, two fixed routes, come next year, but that's still a work in progress.
Okay, so we're gonna look at just some KPIs here, some overtime. So you can see this is just FY25 over FY24. This is the urban drivers. Again, this is the percentage of hours that are either at overtime or higher, overtime and double time. So you can see we made some progress there. We're about 2 or so% lower than we were at this point last year, and we've been consistently lower through the year. So that's been helpful for sure. Urban maintenance also making some progress there. You can see we're a little bit above. This is a little bit more susceptible to like how many people are out in workers' compensation and things like that. It's a much smaller amount of staff, and so when you have someone out on leave or whatnot, certainly the overtime is going to be driven by that. But at least for the last couple months, definitely some progress over last year there. St. Albans drivers, we've had a couple months, but it's picked up quite a bit over last year. This, I think, is primarily driven by we're not using any more taxis. So, our drivers are doing more of the trips. And so I would expect the overtime rate to go up a little bit. But the good thing is we're not paying, an outrageous amount to a private operator to do, a huge number of trips up there. So I will definitely take a higher overtime rate up there to not be paying a private taxi operator. And then Berlin. So yeah, had some very, very far below, for the first couple months. It's picked up a little bit over the last couple months. So we'll have to dig into that. My guess is, again, a much smaller pool of drivers up in Berlin. So, if you have a couple folks out or a couple folks that leave, that really can jump up the numbers quite a bit. And then maintenance up there, again, this is like 2 or 3 people. So again, this is, a much smaller pool of folks. But over the last couple months, doing much lower than last year. But, as I said, because it's a small amount of people, it can be quite volatile. And then private taxis, 0. So this is great, you know, and this is Medicaid in the blue and O&D in the red. But you can see we made tremendous progress up there. So no more private taxi operators, and we're very happy to see that.
But Buddy's not very happy.
Yeah, no, I don't think Buddy's calling us anymore. But we thank him for the service he did provide over the years. It's just, you know, just definitely more cost effective for our folks to be doing it. And then just the checkup on urban expenses. So I did make some adjustments here for things that I felt that could manipulate the numbers a little bit. You know, like we have a number of pass-through funds and things of that nature. They can make our expenses look better than they normally would. And so I do make some adjustments when I feel like they should be made. So for example, we had some CCRPC, you know, kind of pass-through funds and things for projects for Falville. So I pulled out both the expenses year-to-date for those as well as the total amount from the budget because I felt like it manipulated the numbers a little bit. So so you can see without that adjustment, we're about 32.4% of spending for the year. Again, our benchmark is 33%. So even without this adjustment, we are doing good. And then with the adjustment, it's a little bit worse. It's about 32.9%. So this is the figure I would like to use as a threshold, but feel free to challenge me on that if you'd like. And then just lines that we're paying attention to. And again, I did send out the financials, you know, you can follow along if you want with that. But, you know, we're always paying attention to driver wages. You know, we're over benchmark. We did have bonuses go out, I think in July. So I would expect to be, you know, a little over benchmark at this point. This is, you know, even with the bonuses, a little bit higher than I'd like to see us at, but we'll continue to pay attention to that. My expectation is with the service cuts that are going into place, we should be all right for the year and not go over benchmark, but we'll have to see. Dues and subscriptions are, you know, again, this is kind of a very small portion of our budget. We did have a couple items that, or at least one item that happened in the first 4 months of the year that took up the majority of the budget. So not overly worried there, but I did want to include it because it was a pretty large variance from where we'd expect to be. Consulting is a little bit higher. Again, this is, we have some one-time funds that have happened there, such as the Neckerson group, we paid them. As well as some JEDI consulting for that committee. We've actually since then moved that to be funded through planning dollars, so that I don't expect the consulting budget line to continue growing as fast as it has. Facility maintenance, my expectation is this is due to not utilizing capital funds that were provided to us so far in the year. I've talked to a number of folks and my hope is they'll start billing those costs to capital. So my hope is you won't see this budget line continue to grow as fast as well. Passenger facility, we had some expenses that were not in the budget that occurred specifically around some seats that we put in for AARP, I believe it's for older folks. So didn't have that in the budget, but the good thing is we had revenue to go along with those expenses. It was funded by a grant, I believe 100%. And then miscellaneous maintenance, we got some new vehicles in, I believe we had to get new radios. So our radio costs were higher than I would have liked to have seen for the year. But again, it's really kind of dependent on when the vehicles arrive. Looking at the rural side, again, I didn't see any need to make any adjustments here. So we're at 31% of the budget, which is good. We should be below budget though at this point because the seasonal service hasn't started. So all those seasonal expenses for the drivers and whatnot are in the budget figure. But you know, the expenses will not start until about December. So if we were above benchmark at this point, I would be very concerned. So, but we're not, and so that's good to see a lot of the similar lines here from the urban side. You know, driver wages. little bit concerned about because, we did have the bonus, but there's much less drivers, so the bonus is a much smaller component. Plus, haven't even started seasonal yet, so I am a little bit worried about where we're at on driver wages on the rural side. I could see that ending the year likely over budget. Dues and subscriptions, same thing. We just had some very large one-time items come in, especially on the rural side. We have to make an annual fee to VPTA, the Vermont Public Transportation Association. That takes up a very large share of that budget, and that payment's been made. Communications, not sure what's going on here. I need to do more digging on this. I think there could have been some price increases, but our costs there have grown over last year, and so I need to dig into that a little bit more. Legal fees, again, this is, it's hard to predict legal fees, so my hope is we'll see that go down a little bit, seeing that we don't have any collective bargaining agreements to deal with on the rural side, but we'll have to see. Consulting, kind of the same thing. We had some JEDI work, some other kind of one-time things happen as well in that budget line. Driver uniforms, a little bit over, but again, we kind of buy uniforms as we see fit, and it's typically only a couple times of the year, so I think we'll be all right there. Miscellaneous operating, again, this is the radios that I spoke about. We had a lot of new vehicles come in, had to buy radios for them. Facility maintenance, the same thing. Capital, we're not using our capital funds yet. And miscellaneous maintenance, I'll have to look at my notes for that. I think that was, we had to print the bid. So that was a costly endeavor. Quite a lot of copies have to be made for that. And then the urban shop allocation is really due to one large ticket truck item that we've done year to date for the rural side. And again, that's work that the urban maintenance shop does for the rural side, and we allocate those costs over to the rural. So sorry, that was a lot, really quickly. And then just the bottom line on the urban side, again, like I said, we're showing about a $58,000 loss. Go ahead, Dan, sorry, I didn't see your hand.
Dan?
Yes, thank you. A quick question, the call center and
Yes.
the additional call center staff in the Berlin shop and the St. Albans shop, any impacts yet on the rural budget side with those costs included? Or maybe it's too new to be captured, so.
Yeah, so those costs, we keep them out of the transit rate, so they won't impact that. However, we do have like some folks that do allocate a little bit of their time when they are doing non kind of broker services related activities. But I will say they're included in the Medicaid profit and loss that I send to Elaine. And Elaine hasn't been very she's been surprised, let's say, just by the growth and costs there. But we're only actually losing about $30,000 year to date in Medicaid, or at least as of September. So at least we've seen the revenue come in to kind of offset those costs. And to be honest with you, I think we needed that staff, that level of staff to be able to manage what is a very complicated program. So I hope that answers your question, Dan. Let me know if it doesn't.
Yeah, no, thanks, Nick. It does. Appreciate it.
Okay, thanks. And then on the urban side, as I mentioned, we got a loss, but really this loss is the result of not having the local match to be able to draw down the formula funds to cover that. We do have COVID funds that I could have drawn down to cover that $58,000. So I want to be very clear. This loss is a result of a decision I made in terms of the grant billing, because I wanted to see how the rest of the year went and see if local match improved, because we're really trying to conserve COVID relief funds for next fiscal year, for FY26. Go ahead, Michael.
Mike?
Not having enough local match, I don't quite understand it. And people haven't paid in, or it just exceeded what we normally have?
So it has nothing to do with like when we get the money, because we go everything on an accrual basis. So it's really when we recognize the revenue that counts as local match. But the reality is based on accrual accounting, I didn't have enough local match to be able to leverage the Formula 5307 funds, and they require a 50-50 split. So if I want to draw down $1, I got to show $1 of local match. I was short, well, I was short about, year to date, I've been short about $71,000 in local match. Now, the reality is I could have used COVID funds, which we do have. I could have used those funds and covered that hole. But I just we're trying to conserve those funds for 26, which is going to be a very tough year. And so I wanted to see if I could keep us on target before I drew any of those funds down, because the state will start showing higher local match revenue in the next couple of months, because the legislature gave us an extra $600,000 or so. And so I do expect to hopefully be able to cover that gap with regular formula funds. And I know it's very complicated. But yeah, so just know that loss is of a making of my own, and not as a result of us not having enough access to grant funds. And then just down below, I wanted to show, one of the major metrics, and sorry, let me zoom in here a little bit. Oops, my bad. I messed things up. There we go. Okay, well, let's see if I can do this again. Okay, hopefully that's a little bit better. So this is a major metric that I pay attention to on the urban side, because it makes up such a large share of our overall budget. So our federal Formula 5307 funds, as well as our JARC funds. And then I deducted obviously the expenses, or I added in the expenses that we will ultimately draw down, because these are expenses we've incurred. We just haven't, drawn the funds down yet. So when you factor in that extra $71,000 that we haven't drawn down yet, which we will eventually once we have the local match, plus what we've drawn down currently, we end up at about $2.2 million of reimbursable expenses against a budget of about 6.7. And again, this is just 5307 and 5311 flex funds. So we're actually right exactly on target of where the benchmark is. So the benchmark's 33%. When you factor all these in, we're at about 33%. So I'd say, on the urban side, in terms of where I'd like to be for the budget. Now, there's certainly some expense lines that I'm not thrilled with. The driver wages especially is one that I get a little nervous with. But in terms of our spending out of our largest grants, we're right on the benchmark. Now, I'd like to be below that, but I'll take right on as well. And then looking at the rural side, where we're showing a loss, and again, this is not a loss of my making. I want to be clear with this one. So we're showing about $105,000 loss. This is really due to the O&D program. And so in a sense, it kind of is a loss of my making, because I made some decisions that have somewhat led to this. And it has to do with O&D grant funds. So last year we made a lot of money. We made like $900,000. And so I made the decision to stop charging fees to Washington and Franklin County in the O&D program, because I wanted to be able to extend that program. And also, if we're making $900,000, we can afford to extend the funding in that program. So I made the decision to stop charging fees. So that is revenue that was lost. And also, we were having some issues with the administrative funding that was provided for us to manage the O&D program in Chittenden County. V-Trans historically provided us $50,000 a year, which I told Dan, because we made so much money last fiscal year, I said, we don't really need that funding anymore. Now look what's happened. And the fees are not all related to this loss. Part of it is Medicaid. We're losing about $30,000 there, but it's the combination of not charging any fees to run the O&D program currently. And it's also more so the result of our transit rate that is actually about 150, as you saw right now, not being close enough to our set fixed transit rate that we actually do our billing with in route match. which is at about $115. Now, I know this is hard to understand, but we have a dispatching software that you cannot have a variable transit rate in. I can't go in and change the amount we're gonna charge for service every day, right? Based on what I'm seeing. You have to pick a flat rate. And so our current rate in route match is set at $115. The problem is our actual cost, the rate when we look at our actual cost is, as you saw, up in the like 150 range right now. So that spread between 150 and 115 results in us not billing as much as we should be for this program, meaning the revenue is not coming in. So when you look at our O&D grant revenue through October, last fiscal year, we were at 628, we're at only 620. Our costs have gone up significantly, as you've seen, and I've shown, they're up roughly 18%. There's no reason we should be billing this less than what we billed last year, but because we're not charging the fees, and because our fixed rate is so much lower than our actual, that's what's driving the majority of that loss at 105,000. And so what are we doing to fix this? Well, we're gonna start charging fees again in Franklin County and Grand Isle. So that'll start showing up in the results soon. I'm gonna be talking to Dan about trying to find a way to get us that administrative fee back in Chittenden County, that $50,000. So that should help. And then my hope is that the rural transit rate is going to start dropping as seasonal service comes back online. So that should help fix itself as well. So I know that's a lot and very hard to understand, but that's what's driving the red ink on the rural side. So does anybody have any questions on that?
Questions for Nick? Nick, who pays those fees to Washington and Franklin County?
Well, VTrans pays the majority of it, so the local partners pay a very small share of O&D costs, like roughly maybe 5%. They provide a local match of 5%. So really, it's like 95% VTrans, which supports that program with 5311 funds, I believe. But the nice thing with E&D is there's only a 20% local match requirement. And you can use in-kind match to help subsidize that. And we generate that with volunteer driver hours. So you actually can bring the local match need down from like 20 down to 5, which is what we do because we have volunteers. But yeah, so we're gonna make some reforms, and I'm hoping in a couple months when I come back to you, we will not be showing $100,000 loss anymore.
If you had continued to collect those fees, would there have been any negative aspect of that?
Well, we might still be showing a $30,000 or $40,000 loss because that's what we're losing in Medicaid right now, roughly. But so it would probably be in the $30,000 to $40,000 range, or at zero, because again, we do collect operating revenues, and we don't net the majority of those against our grants. So the investment income that we generated might have covered the whole loss, or we might have shown a gain. So it's, but yeah, we need to be charging fees again for that program. We were happy not to do it for as long as we could because we were, showing some gains, but we can't continue to operate at a 6-figure loss. So we'll be making those changes. Okay, so just again, we'll touch Medicaid. As I mentioned, we're losing about $30,000 there. And this is as of September, so please note that we're currently the financials I sent you were as of October, but the last P&L I did for Medicaid was as of September because we do it based on a quarterly basis. So you can see we had about $745,000 of revenue, about $773,000 of expenses. So we've got about a negative 4% margin there, which we will do a true up at some point. And so hopefully we'll be reimbursed for those losses in the next couple of months. And then just looking at the investment portfolio here, I like to show this every time I do a review. So you can see we've got about $3.7 million in treasury bills. And unfortunately, the Fed has been cutting rates. So interest has gone down, but we're still doing pretty well. So year to date, we've generated about $53,000 investment returns. And then since we started the program, we've actually generated $318,000. And this is one of the reasons we've been able to take some of the local money, you know, like last year when we had a big gain, and just go and buy vehicles with it. So we've been able to reinvest some of these additional returns in new capital.
Nick, are these basically all COVID funds that are being invested?
No, these are all local dollars. So
Because
what
you
happened,
spent
Paul,
down,
was sorry, go ahead.
because you've spent down the COVID, so now you have local funds to invest.
Well, when we had those COVID funds and we're using them, we didn't have to use our own local funds that we were getting from all the municipalities. So all that money kind of just fell to the bottom line. And so that's how we built up this kind of, I don't want to call it a war chest, but I'd like to call it a rainy day fund. You know, this is the funding that, you know, we're going to use as we need to restructure the company. And, you know, GMT is a very capital heavy business. We need a lot of liquidity here because, you know, we're 2 months behind in grant billing and, you know, we're over 200 people that work here. So, you know, we need to have a lot of cash available to us. And so this is going to be very helpful as we move into the future. And it has been. So go ahead, Dan.
Yeah, Nick, just a question about this. I'm so glad you've been doing this. Can you remind us what is the amount of urban local money that's in here? Is it also rural local money that's in here?
This is a technical, well, so as you know, we have one singular balance sheet, right? We have, you know, we do track urban and rural cash individually, but we have one bank account. We don't have we have multiple bank accounts, but we don't segregate the cash between urban and rural. We do track it. And the reality is all of this cash technically is rural because the urban side is so cash, it needs so much cash that the rural side essentially is always loaning the urban side cash flow. And so all of these investment returns, Dan, that we've generated have all been put to the rural side because it's technically all rural cash. And that's why we were able to buy those vehicles on the rural side, or a large reason we were able to.
Excellent. Yeah, thank you, Nick. Appreciate that update.
You bet. And another reason why, you know, when we met the other day and we talked about cash flow, you know, when we talk about the possibility of the rural side being split from the urban, this is the exact reason why I'm concerned about cash flow, because, you know, the urban side is always, it needs so much more cash than the rural side, and we don't get the same upfronts on the urban side as we do on the rural. So if the rural side did go away, we would need to find a new banker for the urban side because the banker so far has been the rural side. Okay, so, you know, again, we've only had 4 months in the fiscal year, so we haven't done a ton of capital investments, but we have done some on the urban side. You know, we have had one cutaway come in, as well as we've had a couple more expenses be done on the lift. And then on the rural side, we did have 9 cutaways come in, so that's very helpful as well. I apologize, I don't have a net capital investment figure for you yet because I don't have any depreciation figures, so we'll have that for you next time. And then just what are we working on, you know, currently? Plenty is the answer. So we have, you know, we're dealing with the fiscal cliff every day, so planning for that. We do have a public budget meeting coming up, and I do want to tell you the time, so I didn't write it down, did I? I believe it's December 13th at 12:30 p.m. And then December 14th at 5:30 p.m. So if you would like to attend, please feel free to do so. We're going to be doing 2 of them this year. And then
you mean January, Nick?
Yes, I'm sorry, Paul. I'm already losing it. So yes, January, next week, I believe next Monday, and next Tuesday, 12:30, like I said, on the 13th and 5:30 on the 14th. The FY24 audit, I already touched on that, so I won't go into that. You know, obviously we need to get going on I'm looking at for an accounting software consultant. So we'll be working on that hopefully in the next couple of months when things slow down. We do have a paratransit RFP that's coming up. We've got some decisions we need to make on that. The triennial review is coming, and that will be a heavy lift for everyone. And then at some point, we'll see a dispatch software transition that will occur, but we continue to be told that that is taking much longer than expected. So, but that's all I have. Sorry, I know it was quite a lot, and I hope I thank you for the extra 4 minutes you gave me. So.
We didn't give it to you, Nick. You took it.
Yeah, exactly. I robbed it. So.
Any questions for Nick? Comments? Well, it's always impressive how complex this organization is.
I agree with you there.
If there are no questions, comments, is there any other business to come before the committee?
Actually,
Yes, Michael?
Nick, at what point, if a decision is made to separate the two, does that just fundamentally change how you approach finances? And is that going to be how much of a drain for you and your staff? You know, we were talking about mid-management and not having enough people. I'm just wondering if, you know, having sent the signal that we want to continue to explore this, which may lead to a decision to go forward to it, what's the impact on you guys, and when does these meetings start to change?
So there's pluses and minuses to the whole thing, right? My staff would have a lot more capacity to do more. I would have a lot more capacity to do more, you know, future financial, like more financial planning and analysis. You know, a lot of times the rural side, I spend more time on that than I do the urban. You know, it's just so I think we'd have a lot more staff capacity. The negative is on a cash flow, you know, but we can solve those problems. You know, I'm already, you know, looking at a line of credit to solve that. The financials would improve. Number one, because as you see here, I mean, I'm all over the place. I mean, I do the best I can to really explain things to you folks, but the rural side is very complicated. And so, you know, I think it would be an easier organization to understand on a financial level. But also because the rural side slows down our production of financials, I would be able to probably provide you folks, you know, I wouldn't be 2 months behind. I might only be 1 month behind. So for example, I might have been able to bring you folks November financials today instead of October, just because the rural side really slows down our grant billing. So there's a lot of pluses and minuses to both. But you know, I'm happy to go into more detail with you, Michael, but you know, it's certainly something that is, I think, undecided at this point. And I leave that up to the board to, you know, hear input and then make the best decision, you know, they can.
So Michael, with your question kind of focusing on when we would start transitioning and how that would impact how we, you know, manage our finances. One of the things that I think is absolutely going to have to happen is that we, you know, bring on some type of temporary transition director. We're struggling to, you know, to handle our daily business and to go through everything that would need to happen with a transition, and to put that on existing staff is just, you know, continues to be unfairly asking for too much of the people.
That's what I was.
Yeah,
I'm impressed with all the juggling done, but I was just thinking, how is it even physically possible? But thank you.
Yep.
Yeah, Chapin?
Great. Thanks, Nick, as always, for being so on top of our financials. And I know running a rural and an urban financial system and the day-to-day operations here is quite a hill. So I'm wondering strategically, with Clayton and Nick on this call, you know, one of the striking graphs that you've continued to bring forward to us is the unsustainability of our over-reliance on federal funds. And I'm worried that, you know, this house of cards, should there be a reduction in federal funding, which under upcoming administration is not out of the question, that we need a sustainability kind of strategy. And yes, some of that is at the legislature, which I think we've discussed, but I would be interested, Clayton and Nick, if we as a board could help, and maybe the finance committee is where it starts, that we have what I'm calling a revenue diversification strategy, where we're figuring out how are we, whether it's eliminating the let them ride policy, implementing screening for discounted ride eligibility, getting special assessments approved by the municipalities, renegotiating our unlimited access programs. We've talked through a number of these strategies, but we haven't really given voice to like a coordinated financial sustainability effort. And I wonder if there's value in that, both for helping the board stay focused, but also really demonstrating to our partners, like at the legislature when we're asking for more money, that we've got our game on.
Chapin, I think that you're absolutely right, that that's something that we're going to need to advertise, and certainly all of the things that you listed are going to be included in our next report, so that we could highlight that, you know, that we are not operating business as usual. You know, if we were at other times, you know, I would say that the amount of money that we would save by having like a person focused on this, I would, you know, hire somebody else to do this. But this is not, you know, the normal times, and I think especially, you know, when we look at the finance department's staffing, you know, we are going to have a staffing issue there shortly, which we could discuss, you know, offline. You know, it's something that, you know, I don't know how we're going to do this other than kind of the way we have been doing it, which is, you know, more catch all, you know, catch as catch can, which, you know, certainly is not systemic.
Clayton, I wonder, as Chapin was reiterating all the issues we've talked about, if that could be consolidated in one report to the board, just to keep front and center all the things we've talked about as potential revenue sources. Because it's easy to lose that.
I agree.
And could I fully support that? I think that's where we definitely have to go. I would just add to that list, reimagining routes. If we can change routes, how we can generate more revenue, because our structure is sort of built on past practices or past demographics, and there have been truly substantial changes, and there are new changes in the works. And I think there is a role for municipalities to be bigger partners, because, you know, we basically go up or down together.
And this, thank you. I really appreciate everybody's interest in this. One piece I will add, you know, at the DPW side over here in Burlington, once people have the convenience payments through either credit card or through phone payment, there seems to be more elasticity in kind of people being willing to pay a fair share. At least we found that with meter rates. We've just increased our meter rates in Burlington on January 6th, and there was very little public feedback because people really don't care whether it costs $1.50 or $2 to park. They just want it to be easy. And I want to understand how GMT, you know, by making it easy, can not only get more seats in the bus, but look at, you know, are we asking the riders to cover the transaction costs of these convenience payments, et cetera. So thanks for all the positive feedback on this. I just wanted to float this as an area that I think in future finance committee meetings, I'd love to delve into.
Any other comments, questions?
Paul, I just have one last thing. Historically, I think we had an ADA customer service survey done recently for SSTA. So best practice is really to have, you know, an analysis done on the customer service results of our contractor, especially for ADA. And so I have those results now, and I think we brought this to the finance committee before, but maybe just because ADA historically has kind of always fallen in my department. But I just wanted to see if that's something you folks would be interested in hearing still. Is that better to go to like the governance committee? Like, I'm trying to figure that out, because I do want to share the results with the board and then ultimately with SSDA, so.
Any thoughts on that from committee? Seems though governance would be an appropriate spot for that.
Okay.
Well, I was also gonna
I'll
maybe
work with
suggest
Clayton.
the performance committee might also be the appropriate board committee for that.
Okay. We can do both if they both want to hear, but yeah, the performance probably would be the most appropriate. So, all right, I'll work with Clayton and we'll bring it to that committee, and finance kind of seems like a weird place to honestly bring
Yeah.
something like that,
I
so,
agree. I agree.
yeah.
Any other business? If not, a motion would be in order to adjourn.
So moved.
Thank
I'll
you, Michael.
second Michael's motion.
Thank you, Will. All those in favor, please say aye.
Aye.
Any
Aye.
opposed? We stand adjourned. Thank you all.
Thank you, everyone.
Thank you.
Okay.